Welcome to My Steel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. I'm Nikki Fu, Commercial Director at My Steel Global. From July 24th to 30th, China's LPG market extended its upward run, though the pace of gains eased compared with the prior week. China's domestic supply and vessel arrivals both pulled back, downstream burning demand stayed soft, and inventories at producers and ports moved in opposite directions. So, what was really driving the market this time? Joining us today is Aibo, lead LPG analyst at MySteel Oilchem. Aibo, welcome back.
Thanks, Nikki. Great to be here.
Let's start with the headline. China's national LPG benchmark rose 4.46% week-on-week to 5,993 yuan per ton, and Ether Post C4 climbed even more, up 4.74%. What was behind this latest leg higher?
Geopolitics again, but with a twist. A temporary US-Iran ceasefire and hopes of renewed talks eased market anxiety early in the week and pulled some premium out of crude. Brent still averaged $92.13 a barrel, up 3.13% on the week, though prices actually dipped midweek before crude rebounded again on the final day. Domestically, the market leaned less on a supply shortfall and more on tight regional balances. Both refinery output and import arrivals declined. So, prices kept grinding higher, even with softer downstream demand.
So more of a slow burn rally than a sharp spike?
Exactly. South China, which had been trading at a premium, fell back sharply as extreme heat and weather curbed demand, while East China, previously cheaper, rose on tighter local supply. Ether Post C4 dipped early on bearish sentiment, then rebounded as supply tightened and crude jumped again late in the week.
Let's look at supply. Commodity output slipped 0.47% to about 425,800 tons, and vessel arrivals collapsed 44.16% to 614,000 tons. That's a sharp drop. What happened?
On production, a Shandong refiner went into maintenance and some producers held cargoes for their own use, partly offset by Goulet refining resuming shipments, so output only edged lower. The bigger swing was shipping. Typhoon Hongxia disrupted arrivals into South China and Fujian, so actual volumes came in well below plan. East China arrivals were also lighter than expected. For the month of July overall, though, arrivals were still up 86.57% versus June, so this week's drop looks like a short-term weather dip, not a structural pullback.
And demand?
Mixed. Propane and butane-based chemical consumption both rose, while olefin C4 demand dipped slightly, so overall chemical demand expanded. PDH run rates climbed 1.34 percentage points to 72.76% as a Fujian unit restarted and an East China unit resumed after a short stoppage. But burning end demand stayed weak, and the sales-to-output ratio fell 3 percentage points to 99%. South, West, and Central China saw the sharpest declines. Central China dropped to just 95% as buyers turned cautious after the price run-up. Shandong was the exception, where tight local supply kept buying active.
That brings us to downstream margins. PDH profitability jumped again, while alkylation stayed underwater.
PDH margins rose another 17.42% to 1,072 yuan per ton in East China, and about 941 yuan per ton in Shandong. Propylene dipped early before rebounding, but propane feedstock stayed cheap throughout, so the spread kept PDH plants comfortably profitable. Alkylation margins stayed negative at 683 yuan per ton, barely better than the prior week's negative 692. Crude swings kept feedstock and product prices moving together, so costs stayed high and margins thin. Malaysian hydride margins fell another 24.54% deeper into the red, while isobutane dehydrogenation margins narrowed 16.1%.
Inventories. Producer stocks rose while port stocks fell. What changed?
Producer inventory ratios climbed 2.05 percentage points to 23.47%. With prices elevated, downstream buyers grew cautious, and southern weather disrupted producers' ability to move cargoes, so stocks built at the plant level. Ports moved the other way. Sample inventories fell 1.71% to 2.482 million tons, because this week's steep drop in arrivals couldn't keep pace with steady chemical offtake. So producer stocks rose on soft-burning demand, while port stocks fell as imports temporarily lagged chemical demand.
What should the market watch heading into next week?
We still expect prices to stay firm, up roughly another 30 yuan per ton, but supply and inventory are set to shift. Refinery output should ease slightly further on more maintenance, but vessel arrivals should rebound once this week's typhoon delays clear, so the market likely swings from deficit back toward a small surplus. On demand, chemical consumption should keep improving as more PDH and isobutane dehydrogenation capacity comes back online, though burning end demand stays weak, with buyers purchasing mostly on an as-needed basis. Both producer and port inventories should build as arrivals recover, and that extra supply pressure plus thinning margins, especially in alkylation, leaves some downside risk once this round of geopolitical optimism is digested. The Middle East remains the biggest swing factor. Any fresh escalation could push crude and LPG costs higher again quickly.
Thank you, Aibo, for sharing your insights. This week showed that even as the geopolitical premium eased and supply pressure mounted from higher inventories, tightness in vessel arrivals and firm chemical demand were enough to keep China's LPG market grinding higher, just at a slower pace than before. Going forward, the market will be watching whether the rebound in imports and refinery supply outpaces the recovery in chemical demand and how much further burning end weakness weighs on the balance. Aibo, thank you again for joining us, and thank you to all our listeners. If you'd like to follow these developments in more detail, the full analysis and data behind today's discussion are available through MySteel Oilchem's latest China LPG Market Weekly Report. For more information, please visit mysteel.net or contact us at inquiries@mysteel.com. Thanks for listening to MySteel Commodity Flux. If you found today's episode helpful, be sure to subscribe for more analysis on global commodity markets. Until next time, keep tracking the flows.